Good afternoon, ladies and gentlemen. Welcome to Market Today and its most important shuru, Market Gurus. We are welcoming Mr. Dhirendra Kumar, CEO of Value Research Online, amongst us. Dhirendra is a very well-known observer, analyst and advisor in stock markets. For the last 3 days, he's analyzed almost every single mutual fund in existence and has a very enviable trait. In a roaring bull market, he can remain calm, and in the most ferocious of bear market, he can remain calm as well. We welcomed Dhirendra today to set the tone for the next year or so as far as markets are concerned, and to listen to his calm voice to understand what's happening in the markets. Namaste Dhirendra, a very warm welcome to you, sir.
Thank you.
Dhirendra, we'll start with the very basics. People are now really worried. We've seen about a 16% correction on the Nifty. The small cap and the mid cap indices have corrected more than 25%, and the sectoral indices have fallen much more. One, are we sitting in a bear market, and if so, how do you analyze sentiment on Dalal Street?
Markets are like this only. If you look at the markets, most investors look at the way people start investing. Investors get attracted to most recent past performance. They chase that. And this is where the disappointment of the relatively new investor is visible. Small cap funds are down 20% in the last 3 months. But at the same time, the small cap funds are down only 3% over the last 1 year. And if one invested 3 years ago, one will still be sitting pretty on 16% annualized return. So I'm talking of the small cap fund, which has been the most vulnerable, which has seen the biggest decline in the shortest period. So if you're a long-term investor, I think you don't have much to worry. But if you are an accidental investor, you somehow just invested in the fund, you just invested in a mutual fund, and you expect it to do all, mutual fund can't be, or any equity category, can't be a 15%, 18%, 20%, yielding fixed deposit. It comes with, the point is that equity is able to give you 18, 20% kind of return. But the catch is that it doesn't give you every month. It doesn't give you every year. It is not consistent. It does not move in a nice straight line. And that is where, some years you will get phenomenal return, and some years, sometime, or a phase when you will see these declines. But at the same time, I think people just don't, only the short-term investors have this exaggerated, they have lost their sense of proportion. Markets going down by 20% or 15% in a 3 months time period is a very usual thing in the scheme of things.
Fair point. So with that background in mind, let's now start analyzing separate segments of the market. Dhirendra, because you analyze each and every equity scheme as also debt scheme in great detail, one how should I say, thought that is there in the market is that a lot of mutual funds have got themselves into many stocks which have little liquidity, and are now paying the price of a very costly exit. To those who have SIPs, especially in small caps and mid cap funds, what would be your suggestion when you look at the broader makeup of portfolios in this specific segment? Are they really prone to a lot of risk on the downside, or will they sort of over time overcome this problem as well?
No, this is actually the nature of the small cap. Small cap stocks. Let me just give you a background to this. SEBI defines, small cap, mid cap, large cap for sake of, classifying mutual funds. So top 100 companies are referred as large caps. The largest of the 100 biggest companies in the country by market capitalization. Next 150 companies are mid caps, and the remaining companies are small cap. Now the remaining company universe, if you look at it, that is a universe of nearly 4,500 stocks. 4,500 stocks which are listed on the market, of which 3,500 stocks trade every, 90% of the days on which the market is open. 250 days of trading days in the market, and they trade on 90% of the days, which means that the investable universe of small cap stocks is 3,500 companies, of which the mutual fund investment universe is the total equity universe. If you add up, if you list all the stocks in which Indian mutual funds invest, it does not exist, it does not exceed 850 stocks, which means that if you take away the top 250, the remaining is the remaining is the small cap universe of mutual fund, which to my opinion is a very superior filtration of the small cap universe which Indian investors fall into, the trap that domestic Indian in equity investors fall into. Mutual funds are able to deliver you a basic filtration of relatively superior quality universe. Now, one has to see that, is liquidity a impairment risk? Do you lose capital because of liquidity? Yes, if you realize it. If you have a stock whose capitalization, you can have a great company, but 50% of it is owned by the owners, by the promoters. Remaining is held by other people, and it is such a promising company that nobody else is willing to sell it. Nobody else is willing to sell it, so liquidity can come in the form of, one, it is a small company, and the other is that there are no willing sellers. And in a market like this, if there is, small caps are vulnerable to the action of few investors, and this is the reason why they deliver you superior return, and this is the reason why they are extremely vulnerable if you have short-term expectations. If you get disappointed, if you lose your sleep, when these stocks go down by 20-30%, you are not cut out for them. So the way to deal with it will be, invest in a multi-cap fund. At least the big decline of these stocks will not be visible to you. It will get mixed up with the large cap and the mid caps, and that way, it is actually a trick which you are playing with yourself. Not being visible can comfort you, but
Okay.
if you can withstand these declines, I think, if despite this fall, despite the intermittent fall, despite the 2008 crisis when small caps existed, if you look at any 5-7 year period, small cap has been on top of the pack compared to any other category. The trick is to be able to withstand these phases. The trick is to be able to invest little more if you can, and this is not meant for the faint-hearted.
Right. So, Dhirenji, from what I'm able to gather and surmise, if you are a small cap investor, leave the pain of finding a quality stock and riding it to the fund manager. You
Yes.
continue with your SIPs, let this volatility seep out of the system, and have a longer investment period where the beauty of small cap investing comes to the fore.
Absolutely, and I would also like to bring to
Am
this.
I right?
Yes, absolutely, and I think there is one more dimension to it. You have these bunch of, when you look at the small cap funds, the worst fund is down. The average decline is 20%. You still have about a dozen small cap fund, which are up 12%, 13%, 15% over the last 1 year. They haven't fallen as much. Not only that, when I look at
Okay.
the investors' pain in small cap stocks is far more when in individual stocks. There'll be hundreds of stocks where investors have lost 50, the value has gone down by 50%. I haven't come across any such mutual fund.
Yes. So, Dhirenji, the classic bull market is where, uh, based on whatever little experience you and I have, when you advise people to buy mutual funds, they will say, no, we want the right piece of action, we want to buy individual stocks.
Yeah. Mm.
Well, that's a very, very painful learning curve. And not one, not 10, not thousands, but millions of investors are learning this lesson. in this kind of a very sharp and volatile correction. Let me just take this question a little further as far as the small and the mid cap space is concerned. A common professional friend of ours was quoted publicly about 15 days ago when he exhorted people to pause the SIPs in mid caps and small caps. Since you've been in the mutual fund industry since 1992, uh, one, do you think that advice was necessary? Was he quoted off context? And three, what would be the right step from now on?
I really wonder that is the right or the wrong, advice. I think it is not his job. His job is to manage his money well, and his job is to actually invest the money because people have entrusted his money, their money to him to manage. When I put my money in an actively managed fund, small cap or mid cap, it's an investor's choice. And I think if even at this point, even if when it has fallen by 20%, if somebody started his SIP 5 years ago, in fact, after it has fallen by 10, 15%, 20%, it is a wrong advice to give. Because the moment you tell somebody that take your money out, stop your SIP, uh, it is not the job of an investor. I think, no fund manager has been perfect or good with market timing. And leave aside, fund manager, I'm not very confident that any investor is good with market timing. It actually amounts to timing the market, that where you should be investing. One, whether you should be investing in the market, and second is which part of the market you should be investing in, small cap, mid cap, large cap, or whatever. I think, investor, the deal for any long term investor in equity through a mutual fund is very simple. You are diversifying, you are putting your long term money, you are investing regularly, and if you do it over any 5 year time period, you will be well off. You will be able to beat fixed income. You will be able to beat, inflation. You will be able to, you know, uh, and that's a very rewarding context. If you are able to beat inflation, if you are able to beat fixed income by a modest margin, and one will be happy. If you are able to invest in small cap and withstand these turbulent times and carry on with your SIP, you will be handsomely beating these two basic references, inflation and fixed income, which is available to everybody.
Okay, so we are not going to stop SIPs in small caps. We are going to ride this volatility with a clear mind that these changes happen, and we are going to wait for time to get the shine back on small caps. And we are only talking about mutual fund investments in small cap sector. Now, Dhirenji, the question comes for all those people numbering lakhs who are entering the market uh, at this relatively good time, based on the fact that they are new and probably in the age of 25, 20, sub 30, what do you think should be the asset allocation from now on?
Anybody starting, don't think he should worry about asset allocation. Asset allocation is like buying an insurance. One should, you worry about these declines. Many times, somebody who has done his SIP and started it 3 months ago, invested 15,000 rupees, he was excited, and he saw his 15,000 rupees become 16,500 rupees. And if he's getting disappointed with this becoming 13,500, I think he needs coaching. He needs to be told that he should feel happy that he is able to buy his cheaper. I would desire that a mutual fund or markets should actually not do very well for all the period I am investing, and it should actually go up dramatically only when I need the money. And if that happens to be 5 years down the line, 7 years, so think about it. You have when we have this discount sales, we actually go and buy three shirts instead of one. If we need one. Uh, Here, whenever there is a discount sale, people just run away. People think in terms of pausing their SIP, taking their money out. I think it's very straightforward. Most investors should not complicate it. they should look for a diversified vehicle. They should carry on with their SIP. And if you square up, if you stop your SIP, if you take your money back, if you redeem your investment, all the notional losses which we are thinking of will be permanent. All the losses which are right now book losses will become your permanent loss on your book. Not only that, it will not help you develop the beauty of the market, which has been democratized through mutual fund. Its ability to deliver you a massive capital with your small cash flows contributed into it. Your ability to accumulate something sizable with your small contributions. You will be deprived of that. You are not timing the market. You are not a trader. You are not trying to find this and that. You are a saver. You are an investor, and you are buying with the hope that it's a general bet on economy. If you are confident that 5 years from now, and when I look at any 5 year, the worst point to worst point on a 5 year basis, I don't think any investor has ever lost money.
Okay. Uh, when you talk about a discount sale, this discount sale happens to be mainly because of the slowdown in the economy and the fact that the hope that we will continue to grow as a country, as an economy, seems to be widely accepted given the fact that SIPs haven't come off the cliff. They still continue to be where they are. How long do you think this discount sale will continue in the markets? And what is a level, if you can gauge, where this discount sale will may pause?
I really don't know, but I can guess few things. One is that market is a very elaborate, complex machinery. It is made up of large number of investors, domestic investors, individual investors, institutional investors, who are in turn are representing individual investors. When you look at the NPS money, when you look at the mutual fund money, when you look at the EPFO money, it is not going down. When you look at the insurance companies investing in domestic funds, the real problem has been the foreign investors investing in money, and they are a very sizable, meaningful participant in the market. And there we find that Mr. Trump has brought about a very unique, and a very scaled up degree of uncertainty in the market. And businesses and investors hate uncertainty more than, in fact, investors can really withstand bad news. Investors can really withstand predictable negative news. But greater uncertainty in terms of what you are doing, will it carry on, will it change dramatically? Those are things which investors are able to grapple with. Or combine it with, it is such a significant trading partner. It is such a significant economy, an investor, portfolio investor. So I think that is something which should, once it stabilizes, I think the flow will be back, and that is when I feel that Indian market, based on its merit, based on its relative position, things will be very different. Things will be very attractive, and things can turn around much sooner than we expected.
Given the dramatic changes we've seen since 2014 in the economy as well as the political setup, our Indian markets, do they still have the right growth engines in terms of giving multi-bagger returns? You and I have been in the market since mid 1990s, and we have seen the kind of problems that the economy faced, the country faced. Yet till 2015, 2014, lots of sensible mutual fund investors made tons and tons of money by riding this volatility and remaining
Invested.
invested. With your, with your lens, can you see maybe 10 years from now and then predict what will happen and what should be done to capture that growth?
I would say that, 30 years ago, if I had to build a portfolio of 50 small cap companies, uh, and if I had to, I would have invested in those companies. And of those 50 companies, 40 companies would have disappeared by now. India was a very dangerous marketplace. It is no longer as risky as it used to be. last 20 years, 15 years, 10 years, we have seen the corporate governance, the reporting, the transparency. But still, you can have lousy investments, you can have disappointing investment, but it is up to you to exercise your diligence. You have to see that if people are investing in companies which for last 10 years have not made any money, they don't make profit, they don't grow their earnings, they are unable to trace that, here is a company which is showing growth in sales, growth in profit, but the cash flow doesn't is not visible. I think it is up to you. It is today the democratization of information, the governance standard mandated by the law, the penalty for non-compliance. I think we are a far superior marketplace. It is important for investors to be little thoughtful. If they are not thoughtful, they should invest in a mutual fund. It is very difficult to find the multi-bagger. When I look at with hindsight, when I look at the companies which have, with the benefit of hindsight, the companies which have become 100x or 200x of the ones which we uh, in the last 10 years, 15 years, 20 years, I really wonder that, going by their context, when they were very cheap, when not much was known about them, ever since they have started, gone up by 100x, will I have enough confidence? It is very difficult to guess that. I really wonder that I would have been a great multi-cap, investor, or I would have been able to spot those companies. But today I can tell you that it is possible for many investors to de-risk themselves by investing in 50 of those and hope that 10, 12 of them will actually do well. And if you are able to invest little more in times like this, when many of these funds actually go down in value by 20, because it's very, if you can spot 5 companies and think that they will go up by 50x and you can hold it, it's a very difficult thing. It is not possible for a fund manager. It is not possible. It is possible for a very large private investor. And don't get carried by though that, do some human things, build a diversified portfolio, assume the risk of a small cap company by investing in a fund which is able to spread the money over 30, 40 of them. Even a great fund will not be successful with those 50 stocks that it chooses, which it builds its portfolio with. Even if 10 companies will go down the drain, 10 of them will be multi-baggers, and 15, 20 of them, 30 of them will actually be a middling one. And that will do the job for you. And that is how, if you dissect the performance of this small cap fund or the mid cap fund in the last 15, 20 years, they have existed in this form with their focus. This is what I see.
Okay. Uh, so these 50 supercharged companies, while they're difficult to get them under one umbrella, but I'm sure if we spread our eggs over maybe 2 or 3 funds, we might be able to snare maybe 25. Now, with that background in mind, Dhirenji, what would be the 3 categories of funds that investors can start their SIPs on, or continue with their SIPs, or at least keep these 3 categories or 3 schemes, if you can name, in front of them?
Uh, I would say that if anybody has to start today, they should start with a flexi-cap fund, and they should think in terms of setting up their SIP and not looking at the value for the next 5 years. If you do this, I think you have won the. You really won't have to worry about anything, because most investors are unable to experience the magic of compounding, the power of equity, and see through what happens when you have this time frame. The problem is that once you invest and you watch it every day and you see the madness of the market overtaking your mind, and it scares you so much. And god forbid, if somebody had invested a large sum of money in the last 2, 3, 4 months, I don't think any investor will be very happy if you retired and you actually invested this money. And I find that there is a dearth of real advisors who will help investors navigate through the crazy character of the market in a manner which will help them build trust, help them build, because people see the volatility, they get scared out, and then they think that the market itself is a very dangerous place. No, the way you are getting into it, the way you are participating into it, the way you will actually experience it is the dangerous bit. If you are able to spread your money, if somebody retires today and he has to invest all his money without without any expectation of seeking investment from that, I would encourage anyone with few crore rupees to be invested in the market in a diversified vehicle and to be spread over the last 2 3 years, because this scale of money, how critical it is to your living with dignity, that is actually the primary driver of your risk tolerance. If I have some if somebody has 3 lakh rupees worth of accumulation, and the child's education depends on that after 2 3 years, uh, on this, that person is bound to panic on based on what is going on in the market. You started with the expectation; it is a very optimistic endeavor, and when you see this kind of volatility, uh, instead of understanding, you just get scared out.
So, fair point. We are looking at an individual investor who's in his early 20s, mid 20s, and he has a 25-year horizon. You know, one good thing, Dhirenji, that has happened in the last 5, 7, 10 years is that lots of people have good quality stocks in their in their DMATs. They may have bought them at the wrong time, but
Yeah,
and that's in hindsight only. But
yeah.
overall, when you see the DMAT quality these days, that's fairly superior to what it was 15 years ago. I am sure you would agree with this statement.
Absolutely. Today the understanding about the market, about companies, and somebody interested in knowing about these companies and then investing. Anybody who wants to thoughtfully
Yes.
invest in stock today is far better off. And if you apply a couple of filters, you will end up being a superior investor.
Okay. Now, Dhirenji, we start with the flexi cap fund. How much should be the weightage for this fund? Suppose a person wants to invest 20,000 rupees per month. And what are the remaining two or three segments that you would want to have?
No, I would say that, if there is anybody between 20 to 30 years starting with a flexi cap fund of 20, investing in equity for 20,000 rupees every month, should invest in one flexi cap fund. And uh, only after you cross 25, 30,000 rupees that you de-risk yourself by investing in another one. And if I have to list a couple of them, I can. But there are a good number of flexi cap fund. If somebody who is above 35, never invested in money and never invested in any market linked investment, uh, she should consider a balanced advantage fund or a aggressive hybrid fund, because all said and done, investors own thinking is very malleable. uh, when the market is rising, everybody says that he has the risk tolerance, he can actually withstand the big declines. And the moment we see a 10% decline, people change their mind, they get scared, and they have not experienced it. So it is very important for a grown-up investor to starting with a vehicle which is a little conservative. It will not crumble when the market falls, and it is very important in the initial phase of your investment cycle, that you start in a manner which is conservative. You are not, because markets will remain like this, they will always grow or rise steadily, and they will fall in a short time frame and very sharply. And to get used to it, you have to start in a manner, no amount of amount of persuasion or me telling you anything will help you navigate this. You have to experience it, and the only way to experience it is with a conservative allocation, which is a fund which is 75% into equity, 25% into fixed income. The kind of fall that we have seen in recent times, it would have fallen much less to your comfort and to develop a belief.
Okay. Dhirenji, in the gentlest possible way, I must insist for the benefit of our viewers, if you can name or maybe give a couple of names of top flexi cap funds that come to your mind immediately, two or three
So,
small cap funds which you think have handled this volatility well, and maybe a couple of mid cap funds as well. We'll be very grateful, sir.
Yeah. No, I'll list you four of them in each of the category. If I have to list, the aggressive hybrid category, ICICI
Yes.
Prudential Equity and Debt Fund, Kotak Equity Hybrid Fund, Mirae Asset Aggressive Hybrid Fund, and DSP BlackRock, no, DSP, no longer BlackRock, Aggressive Hybrid Direct. These are the four conservative growth fund, which are aggressive hybrid fund, which will, give you a relatively steadier take on growth. Looking at FlexiCap fund, which I was listing earlier, uh, HDFC FlexiCap, Parag Parikh, SBI Focused, and Franklin India FlexiCap. These come to my mind. And looking at aggressive growth, the small cap and the mid cap, I list, the Axis mid cap, despite its turbulence, I really like it for its quality. Edelweiss mid cap fund, Kotak Emerging Equity, and Mirae Asset Mid Cap Fund. These funds, in the aggressive growth category, for somebody willing to take a chance and will not lose his sleep, will not freak out with the kind of fall that we are witnessing in these categories.
Thank you so much, Dhirenji. What a wonderful
Thank you.
35 minutes in which you've handheld a lot of nervous investors. Thank you so much for your time, and it's always a
Thank you.
pleasure, sir.
Thank you.
This, ladies and gentlemen, was Mr. Dhirendra Kumar, the CEO of Value Research Online, the finest advisor as well as a tracker of mutual funds in India. And he represents a calm face, something which is badly, badly needed at this point of time. Thank you for watching us. Please continue with Business Today Television. There's a lot that's happening on the other side of the break.